Hey folks, welcome to Mr. Market's Mentor. I'm Andrew Packer, and this is for the week ending Friday, August 25th, 2017. Today I want to talk about a big potential danger that could be the cause of the market's next crash. That said, before we get to it, it's been a quieter week for markets. The political and geopolitical fears that we've seen in the past few weeks, they've gone completely by the wayside. That's fantastic. And as I've said before, and probably will again, these fears they'll flare up and then they'll die out just as quickly. They're not as important to how the stock market's going to move, how much your wealth is going to be impacted, compared to the fundamentals of the economy, especially in terms of building your wealth. So don't worry too much about those fears. If those fears cause a buying opportunity in something you like, great, you can take advantage of it, and then you're sort of putting that fear on your side as an investor. But let's kind of get to this bigger issue, which is the fact that something is a little bit rotten in the state of financial markets. They're being unduly influenced by large actors like central banks. As we've kind of seen before, central banks get to set interest rates, and that makes them kind of the biggest player in town in terms of impacting the financial markets outside of political and geopolitical factors. But there's another way that central banks can be troublesome as well, and that's when they buy up assets like non-government debt, and a couple of central banks around the world are even buying up stocks as well. The Financial Times, for example, reported this week that the Federal Reserve owns more than 14% of the total U.S. public debt. It sounds a little scary, when some people say, hey, we owe the debt to ourselves, that might be what they're hinting at. But yeah, we're actually in pretty good shape compared to a lot of other places around the world. Some other central banks, like the European Central Bank and the Bank of Japan, have much bigger exposure. And even England, which is culturally very similar and very pro-free market in a lot of ways to the U.S., has about 25 to 30% of its government debt owned by the Bank of England. So central banks have been just sort of quietly accumulating a fair amount of sovereign debt. So that's just bonds. When you think who's buying U.S. Treasuries, the Fed's usually one of the biggest players in that market. What's interesting is there are a couple of other central banks that are doing other things. The Bank of Japan is buying shares of Japanese companies. And it's now estimated that they are a top 10 shareholder in about 90% of the stocks that make up the Nikkei index. The Swiss National Bank has also been a big buyer of billions of dollars of stocks as well, and mostly U.S. stocks, because the stock market in Switzerland it's much smaller, so they can't really move the needle as much on their assets. But all of these policies it's concerning to say the least. Free markets have big players, they have small players, but when you get to a point where just a few big players come to dominate the market, you really stop getting accurate price signals and an idea of where the value truly lies. And this is a slippery slope for central banks because to a large extent they're proxies, or they're essentially sort of the toolkit that governments rely on when the economy is not doing so well. So it's a way where central banks can inadvertently gain control of the markets. It probably isn't deliberate this round, but if the economy takes a turn for the worse and you start seeing central banks talking actively about buying shares in the stock market, you kind of get to a weird point. Imagine if a central bank got to a point where it owned 10% of a company. Under U.S. law, they could lobby to have seats on the board of directors. I don't think publicly traded companies should necessarily have a member of a central bank, on their board of directors. I think that's getting way too far away from having sort of a free market and from having, a company have its own freedom and self-determination for determining what they want to do as a business, what they want to do operationally. It's just the fact that the bank owns so much of it, now all of a sudden they would potentially have a say in it. Again, that's theoretical, but it's something that's definitely possible. So it's another avenue where central banks can get more control over the economy, but they already have plenty between their ability to print money and set interest rates. And during times of crises, whenever people are willing to throw the rules out the window, they're going to go ahead and do stuff there too. So while it doesn't seem like a problem now, central banks are around the world already buying some stocks, and what that's doing right now in the markets is it's essentially keeping a bit of a sort of a floor under share prices, especially for larger, bigger companies where a central bank can come in and buy $1 billion worth of something over the course of a few days or a few weeks without moving the market. Now the problem is, once you accumulate a very large stake of a position, what's your end game? How do you get out of that trade quickly and easily? And the fact of the matter is, you can't get out of it quickly and easily. So if things start turning against you, you either have to sit through, the next downturn in that stock, or you have to sell and sort of panic sell. And if a central bank has billions of dollars of, let's say Apple, because it's the largest publicly traded company, and they just start dumping that at market, who's going to be able to buy that much at once? Some individual investors might see a bargain and they might be able to pick up a few hundred shares here and there, but they're not going to be able to accommodate all of the flow that's going to come in. So the panic sale caused potentially by central banks could be the catalyst for the next big market decline. That's the problem with having one big player dominating the market. If they have the patience to see the issues through, great. If they're fearful, which happens, not so great. So could be a potential danger, and most folks, when they're thinking about how the market crashes, they always look to the last one, and it's been 10 years since the financial crisis. So a lot of people are looking at the housing market and they're saying, well, prices are going up in most markets. They've surpassed pre-crisis levels in some extreme areas, Bay Area, Washington, D.C., places like that. But, it could just be because central banks have bought so much of assets over the years during the last crisis, and now they're looking to unwind them. That could just be the catalyst that it takes for the market to sell off this time. It's them trying to gracefully, kind of finish cleaning up the mess they were, cleaning up, but also partially responsible for last time. That gets them into trouble. So it's a bizarre factor because it's one that doesn't really include economic growth in there. And it's also outside the normal kind of issues that people think of with central banks causing trouble, like currency fluctuations, interest rate fears, and things like that. So, let's get down to brass tacks here. How can an investor protect themselves? And I have a few ideas that come to mind on this. The first is to buy smaller companies. As I've said, if a central bank is looking to, put billions of dollars to work at once, they're going to be buying some of the biggest companies out there. And if you have a 401k, if you're buying an index fund, chances are you already have, the bulk of your investments in a lot of these big companies already. So buying smaller companies, ones where, a central bank would essentially have to buy the entire company or not at all. If they're going with not at all, then you're not going to have to worry about, them being the big player and them, selling off and causing that. It could, in the event of a broad market panic, it could be a little troublesome. So it's not the perfect idea, but buying smaller companies, still allows you to get the benefits of investing in stocks. Smaller companies tend to be more volatile, but over time, you're rewarded for that higher volatility with higher returns. So I think it's a good way to kind of avoid this central bank buying issue that could potentially flare up in the next crisis. But the other idea, is to buy gold. Central banks are big buyers of gold. I mean, they can also be big sellers of gold. It's kind of the same issue with stocks, except, gold, it's a fundamental commodity, never goes to zero. It can be melted down, turned into different things, but it really can't be destroyed. And there is a store of wealth there. And I think that's critically important too, especially if central banks kind of go the other way, and instead of causing the markets to crash because they own too many stocks, they just go back to money printing, and we get higher rates of inflation. So it's a good protection against that in a different sort of way. Finally, the last idea is just hold a little cash. Valuations in the market are above average right now, and when you have cash, you basically have an option that can allow you to buy companies more cheaply in the future. So if central banks do screw up, markets fall, whether or not it's because they've been buying shares of stocks or not directly, you're still going to be able to capitalize on that opportunity and make money from that. So again, I see this as something that could be a potential problem, and maybe I'm years and years and years early. Maybe it doesn't even happen. But if you don't start thinking about different ways that things can go wrong when you're investing, you kind of get the blinders on. You get too optimistic, and that can be a big trouble too. That's where I think most investors tend to get into trouble, is they get too optimistic. So be willing to think about sort of what's the most outrageous thing that can happen. What's most likely to be the most damaging to my portfolio? How can I protect myself against that? So look at some of the smaller companies that really haven't gone up as much as the so-called broad market, which is really dominated by big caps year to date. Look at gold, and be willing to hold some cash so that you can profit from opportunities that will emerge in the future. So that's what's on my mind this week. Just looking at all of the central bank activity around the world, as they're still pretty active out there 10 years after the financial crisis. So thanks for joining us this week on Mr. Market's Mentor. I'm Andrew Packer, and until next time, stay safe and stay solid.